Welcome back to Morning Trade Live. We got 10 minutes here till the bell opens. It's looking pretty good right now. We got futures bid after PPI. Not a lot, but better than when we were selling off down 1.5% in the Russell this time yesterday. Joining us, Rebecca Walser is the president at Walser Wealth Management. Rebecca, good to see you this morning.
Great to be here, Oliver.
So tell me what's on your mind macro-wise first. I know you got some stocks you're thinking about because we do have some fun earnings, a lot of swings there, stock specifics. But after yesterday's reaction to inflation, pretty warm number, kind of a problem number. I know last time we spoke, you were worried about downside generally in markets. So does this add to that risk, or where are you at?
Yeah, I love it when the PPI comes in line with the CPI, and there's not really a huge surprise because they're disparate. These aren't disparate numbers. We obviously got a hotter print than we were expecting on CPI yesterday, and so PPI coming in higher than expected is one and the same. And it does indicate, Oliver, that inflation is, I hate to use this word because I can't stand it, but it is sticky, and it is going to be an issue this year for the Trump administration. Now, you combine that, Oliver, with the additional complexities of Trump overlaying tariffs, talking about announcing reciprocal tariffs today at 1 o'clock in some kind of 1 o'clock press conference. So you do have the market sort of anticipating, and I think that's why you're seeing a backswing to the green, Oliver. They're taking in what happened yesterday with CPI, and PPI is not that much of a surprise now, and so we're expecting, okay, maybe we overreacted. That's what the market always does. It always overreacts. It's always ahead of its skis a little bit, and this is just more of the same.
Do you think as we are pricing down the odds of cuts, we might at some point this year be talking about hikes? I know it's kind of always this hypothetical we have to discuss, and usually the odds are very low. But yesterday we had Claudia Salmon, who's been pretty dovish in her interpretation of the inflation situation. She was sounding fairly concerned.
Well, I think let's step back and look at what's happening here. And this might be a sea change moment. What I mean by a sea change moment is that if you look at Federal Reserve policy, monetary policy, it really changed after the global financial crisis in 2007 to 2009. And we really became more accommodative. We really became the Fed that could no longer let the markets fail. Whatever happened, we were going to step in and intervene. Too big to fail really became ingrained in our mentality as a country. And so we have been following that now since 2009. Let's just put an end date on that. From 2009 forward. And what has happened is when you add in a global pandemic, when you add in that kind of spending that happened globally to keep the entire world from collapsing when it was basically shut down for 6 months or longer, then you start to see now we have an inflation problem. And what has happened, Oliver, is that we have grown this market. It has grown. If you look at monetary and fiscal, well, let's just look at monetary, spending and policy, and you look at the equity market, look at the S&P 500, you'll see how much in tandem since 2009 they have grown together. So now what is happening is in order to keep this market from really pulling back and having a baseline level without monetary policy, what you're seeing is the market always needing to be so interest rate sensitive, so Fed policy sensitive. And so whenever you see that we start the year with possibly 2 cuts and then, inflation's sticky, 1 cut, oh my gosh, if it's this sticky, it will be no cuts to hiking, you're going to get a very volatile market. And you have to understand that it is not the time to be trying to chase the winners in a market that might be changing monetarily, policy-wise, as well as this administration.
Do you think that that volatility will be led by bonds, Rebecca? Do you think that's going to be kind of the catalyst for shakiness in markets after kind of a peaceful month or month and a half or so in treasuries?
Yeah, I would love for us to have a fixed income year that is fine. But here's the facts. What is going to happen is you're going to start to see demand, global demand. We're already seeing it, but you have good earnings season. I'm not saying the earnings season, but it's always a lagging indicator, right, of what has happened. We're in a new era. We're in a new administration. So as you start to see that we're going to have retaliatory tariffs, we're going to have pullback in demand, we're going to have higher prices, you're going to see that the central banks of the world, China's already there, Japan is already there, Europe is already there, but you're going to see the central banks of the world say, oh my gosh, we have to be more accommodative, more stimulative, more things like this. And then you're going to start to have people realize, is this just a debt bubble cycle that we are entering in? Because in other words, as big as we have grown our federal budget, over $7 trillion on an annual basis outside of war, outside of a pandemic, you can't stimulate a market this size indefinitely, or you are going to be in a debt cycle. So fixed income, bond yields are going to indicate, they're coming down, but if we start to see them, Oliver, start to tick back up, it's the risk. They are pricing in risk that they are just uncomfortable with.
Do you think, how confident are you, Rebecca, in Doge? Do you think that effort's going to solve any of these problems you're talking about? And if so, when would we know? Like, are they really going to trim enough fat to change the health of what you see as being kind of an unhealthy situation?
Yeah, Doge is a game changer, and I think you're going to have a tsunami, and you've already seen it with judges, with injunctions, with Congress pushing back. You've already seen a lot of groups trying to push back against Doge, the Department of Government Efficiency, and this is because we've never had, to my knowledge, this level of transparency in government spending, and a lot of people, a lot of power players that don't really want a lot of information out there or transparency to the American public on how the money is actually spent are going to push back. It is going to be a fight almost to the death to get this information. If they are successful in getting this information out to the American public, and the American public consumes how much money we waste by, for example, sending millions of dollars to Iraq for Sesame Street, Iraqi Sesame Street, if all of that information resonates and gets through the American public, then you are going to start to see federal spending changes, which we must have, Oliver, because we cannot sustain an over $7 trillion budget when we're not even collecting $5 trillion in taxes on an annual basis. That $2 trillion of deficit is not sustainable on a $36 trillion debt that we are already servicing, our fourth largest expense, right behind Social Security and Medicare. Unbelievable.
So what's our solution as investors, Rebecca? Should we be shorting bonds then on this? Should we? I mean, the auction seems they haven't been going terribly. I see your point about the international buyers. The numbers do show that they've been stepping off a little bit, but it's been pretty consistent. Still, we haven't had any super bad auctions lately, which is where I would think some of what you're saying might show up. But should we short bonds then? Should we just be long vol? I know you've got some stocks you like. Is that the way to just not be in the broad market and find specific company stories? Tell me about how it works into an investing strategy.
I mean, I think if you're believing everything I say and you want to take it to the absolute worst possible extreme, then you would want to be in commodities. You would want to be in gold. You would want to be in something that is a long-term hold of stability through decades and thousands of years of time. You know, it's in the Bible, and the gold is in the Bible as a currency. So if you really think that everything's going to blow up under this Trump situation with tariffs, retaliatory, and just the global demand slowing that we see, then I would be in long gold. I would be in long commodities. Bonds and equities are going, I'm not saying it's going to be 2022 again, but we are going to have volatility this year in both. And again, as the risk starts to get realized, that's priced into the amount of debt and monetary stimulus that we constantly have globally across the central banks of the world, then you're going to see the risk yields come up and you're going to see the yields raise. We do like American Express and UPS. We think those are both buys. UPS is 54% off of its high, so it's heavily discounted. And we think that with it diversifying away from its Amazon, 50% away from Amazon by 2026. We like them for a long term. Now, American Express has got a much lower debt to capital ratio, 6.9% versus their peers, 13%. So we think that and debt is at an all-time high, 1.1 trillion consumer debt. With these revolving APRs that American Express enjoys, we think that their profits are going to be really good. Consensus is $15.24 a share, and they've just announced a dividend yield for the first quarter of 17%. So I think American Express on the long term is going to be good through this market, even though it's kind of on the side of people need more access to capital because their options are narrowing. And UPS long term, I think even if we have even kind of another pandemic situation, bird flu, anything like that, the shipping industry will once again be a high demand. So we're liking UPS for that as well.
Love it. Kind of a momentum and a maybe value play, if you will, right? AXP's got good momentum. UPS, kind of the opposite. So I like it. Something for everyone there. And a hot macro take as always. Thanks, Rebecca. Spit and fire. Always fun. Thanks.
Thanks, Oliver.
Appreciate it. Rebecca Walser coming to us from New York Stock Exchange, president of Walser Wealth Management.